I'm Dave Butler. It's 2017. Let's look at cash in Humana. Let's remind ourselves at the start that because Humana is an insurance company, some of its cash flows move differently from ours. Specifically, where Humana offers a private insurance policy, it collects premiums up front and pays cash claims and expenses over time. This dynamic changes to the extent a government program requires Humana to pay first and then seek reimbursement later, but it still has an effect on Humana's results. We jump to the balance sheet on page 83. Notice the large portfolio of investment securities. This is universal of insurance companies. In fact, outside of health insurance, those portfolios tend to be larger because your car insurer doesn't ever have to pay you first and then later seek reimbursement from CMS. We see here that Humana's total liquidity, investment securities plus cash and cash equivalents, went up from $9,838,000,000 to $11,472,000,000. That's a bit of a spike, given how flat the company's revenues are, from $54.3 to $54.4 billion year over year. Revenues, of course, are on the P&L. That's on page 84. When we look at the consolidated statements of cash flows on page 87, we find that Humana had lower net profits, $614 million compared to $1,276 million in 2015, and yet generated more cash. That suggests either some kind of timing effect or maybe a big non-cash cost in 2016. When I search for the phrase cash flow in the annual report, on pages 66 through 68, I find a very detailed discussion of Humana's cash flows from operations. This has interesting information, but there's a quick summary on page 43. The increase in operating cash flow primarily was due to significantly favorable working capital items and higher earnings exclusive of the commercial risk corridor receivables write-off and the long-term care reserve strengthening in 2016. Working capital means the timing of collections and payments, and the same paragraph goes on to call out these specifically. Lower income tax payments in 2016. This is just the timing of those payments, not the amount of taxes paid overall. Changes in the net receivable balance associated with the premium stabilization programs, and the timing of payroll cycles resulting in one less payroll cycle in 2016. The detail is there on pages 66 to 68. I want to focus on the other two items. I search for the phrase write-off, and I find these items paired all over the place in this annual report. They are two big accounting decisions Humana made that dramatically affected its profit in 2016. In the diluted earnings per common share chart on page 6, we see that Humana calculates an adjusted earnings per share, excluding these two items, and that together they accounted for $4.54 of EPS, where the company's GAAP earnings per share was $4.07. In other words, if you didn't count those two costs, Humana's profit appears to have doubled. So this is a big deal. Note A at the bottom of page 38 shows us the numbers, $583 million of write-off of commercial risk corridor receivables, and $505 million of reserve strengthening associated with our non-strategic closed block of long-term care insurance policies. What are those? I search for risk corridor and I find a description of the program and the problem on the bottom of page 26 and the top of page 27. Pause and take time to read through this. To summarize, the Department of Health and Human Services has underpaid insurers amounts that they were supposed to protect them from risks undertaken by enrolling higher-risk patients. In November 2016, insurers suing to collect those amounts lost. Given that loss in court, as well as funding shortfalls for the program, along with some other regulatory changes, Humana decided it was not likely to collect the $583 million it was owed, and it wrote off the amount, decided it wasn't going to collect. That $583 million got subtracted from both Humana's revenues and from its profit in 2016. But it wasn't an actual cash payment Humana had to make. Similarly, the $505 million reserve strengthening was not a cash cost in 2016. Note 18 to the financials beginning on page 135 describes this in detail, but here's a pithy summary on page 57. By the way, I found both by searching for the word strengthen. Here's the deal. Humana has a so-called closed block of long-term care insurance policies, meaning it isn't writing new policies under this program anymore, but there are still old policies around. In 2016, Humana decided, because of factors listed on page 57, like insureds living longer, like claims lasting longer, and also lower interest rates that hurt Humana's ability to generate portfolio income to pay the claims, to take some additional costs. Note that neither of these two amounts was paid in cash in 2016, which is why Humana's operating cash flows were so much higher than its profits. It had a cost, but it wasn't cost it paid in cash, so it was still generating lots of cash. However, both of these costs reflect lower cash that Humana will generate over time, either by collecting from HHS under the Risk Corridors program, or rather not collecting, or because it will have to pay out more in long-term care claims. So a high-level awareness of these two big costs still gives me conversational topics, talking points to raise with a Humana contact. You had these two big non-cash items impact your P&L. Obviously, you'll collect less cash over time, which is reflected in these P&L decisions. How does that impact you? A few other quick observations from Humana's cash flows from investing activities, still there on page 87. The company made minimal cash spend on M&A activities over the last 3 years, though in 2015 you can see the receipt of cash, $1,061 million total cash in from selling divisions, from selling Concentra. You also see Humana's consistent capital expenditures over the last 3 years. Here it's called purchases of property and equipment. This is interesting. I would expect CapEx to drop given the sale of Concentra, since that's a brick-and-mortar clinic chain, and Humana no longer has to keep up maintaining its buildings and tools. To shed light on that, I searched for the word expenditures, and on page 69, I find the explanation that the company's investing in IT initiatives, with a short description of those investments. Here's another thing I might discuss with a Humana contact, either in terms of how my contact is impacted by the initiatives themselves. Is she changing the tools she uses, for instance? Or whether the required investment is putting demands on the contact to generate or conserve cash. Finally, under the cash flows from financing activities section, we see that Humana paid $177 million in shareholder dividends, consistent with prior years, and that it has bought back stock in each of the last 3 years, though in decreasing amounts.